Hey, hi. Yeah, it's been a long time. I think I was away for about 2 weeks. So it's been a good 2 weeks away as well. As you can see, market has gone red for 7 to 8 weeks consecutively, and everything from even the safest stocks like Walmart, Target, grocery stocks. Companies are also giving out lower uh, future quarterly guidance, and the stocks have actually been very volatile as well, gone down like 20 over percent to even small companies like social media companies, advertising companies like Snaps. Small news like that saying that they couldn't probably meet the lower um, band of their Q2 guidance. A small two-liner sentence kind of announcement also kind of caused a market downturn. So I just like to share with you whether giving a intelligent analysis of where we are at right now and where we are looking. Of course, the downside risk, from how I see it, is is lower as market keep pushing down, and the upside risk or the upside potential is greater. And of course, from how I see, the worst scenario would be 9,000 for the Nasdaq index, which now the market closed yesterday on Tuesday. It was at around 11,200. Of course, the whole issue centers on inflations and how the U.S. government and the U.S. Fed, which is similar to our or the Treasury, able to control the inflation from blowing up, uh, to tame it down and bring it down via an inflection point, meaning that there will be, now it's going uptrend, right? At least there's a slow downtrend. And when there's the start of those signs, those could be good positive catalyst that is coming ahead of us. Of course, there are many other good positive catalysts as well, which I will talk about in another video of mine. At this present moment, of course, the whole market is the sentiment is pretty centered on any small bad news, will trigger. So today I wanted to share with you about this cratering markets, reduction of the wealth effects. Um, the wealth effect is an overlooked threat to consumer spending. This is actually a very good thing for markets because that will actually curb and reduce inflation. First, there's a fear factor there. With the reduction of the wealth effect, um, um, significantly in many consumer, especially those that has exposure to stock market or crypto. And then with those reduction in the wealth effect, even though they are paper wealth effect, that would create a little bit of fear and concern, and they would spend less. And when they start to spend less, prices of consumer products or services, they would buy less items, which would mean that demand will go down as well, even though supply chain crises are still an issue or are still a work in progress kind of issue. So I just want to show you about the reduction of the wealth effect that has happened.
All right, so this is kind of crazy, but interesting at the same time because so far this year, we are setting inflation record highs. Our central bank has promised to increase what's called the federal fund rate to 0.5% for the rest of the year, which also happens to be the fastest pace in the last 20 years. CNBC reports that Americans have started to dip into their savings accounts and that this year we have $9,000 less on average than we did the year before. Bloomberg reports there's a $5 trillion wealth shock thanks to the stock market having its worst start to the year since 1939. Crypto just lost $300 billion off its market cap last week thanks to the collapse of a stablecoin. The Wall Street Journal says that real estate growth is on borrowed time at this point. We got our first negative GDP reporting, which means we are halfway through starting a recession, and yet CNBC also reports we're nowhere near a recession. So things are.
So yeah, as you can see, it's actually $5 trillion wipe out from the stock market. So you can see the significant effect on the U.S. consumer. Even though U.S. market is actually quite an international market, but definitely a wipeout of $5 trillion would definitely strengthen the dollar as well. As you can see, they have been printing U.S. dollars during the COVID crisis. Um, at the same time, that one factor would help the economy. And second factor is this cratering of wealth effect, right? It's actually uh, really good for the stocks um, because, as I mentioned before, that will definitely be one factor that not the Fed can do, but Fed is actually indirectly doing it to create. That's why, as you can see from the famous Muhammad Al Erian, the market sell-off doesn't concern the Fed. In fact, they are in no means wanting to help, but to just continue to create this wealth effect crater. So I will put this link of um, for you to read further. As you can see, the U.S. household net effect has also reduced because of um, uh, the wipeout in the stable coins and the crypto as well as the stock for the last 7 to 8 weeks. So these are good signs. As you can see, will trigger on to all the CPI reports, consumer price index reports in June and July. Not now, but it will happen. And then when the inflation start to taper down from 8.5% to around 7 or to 6, it will definitely help the market to push out. And I think it will be good for June CPI and July CPI onwards. So yeah, that's all for now. I will talk about other topics in another video. Thank you very much, and please subscribe and like my video. Thanks a lot.